It was a good year for both stock and bond investors, and it was a year in which diversification and discipline were rewarded. Large cap stocks, as represented by the S&P 500, we see a market that is up about 18% so far on the year, and that's through today. That's through December 29th when we're recording. And so it's been a really good year for stock investors, but not to be outdone, international stocks are up about 30%. And so it's been a really good year. We've talked about some of these catalysts, what's been driving that return, that outperformance overseas. But one of the main catalysts is the decline in the dollar. The dollar is off about 10% against other major currencies around the world. And so that's provided a nice boost to international investments. But let's look at fixed income. So high grade, high quality fixed income or bonds, as represented by the Bloomberg Aggregate Bond Index in the US, has shown performance of about 7% through today. And so it's been a really strong year for fixed income and equity investors alike. We're certainly happy about this. If we just go back to the performance of the S&P 500, that large cap benchmark, I do want to acknowledge that, as I said, it's about 18% return so far through today on the year. This comes following 2 years of 20% plus returns in both 2023 and 2024. And so I want to highlight the fact that 3 consecutive years of 15% plus returns in the S&P 500 is incredibly rare. Going back to the inception of the index back in 1928, we see that this has only occurred 3 times, this being the third one. So it occurred during the late 90s and what ultimately concluded with that dot-com bubble bursting. And then it happened a few years ago coming out of the COVID pandemic. And so this is extraordinarily rare. We know there are reasons for this, the performance of the stock market, but I mention that because it's also important to set our expectations that these things don't go on forever. So with that, let's talk a little bit about our outlook heading into 2026 and some of those themes that we're keeping an eye on. So just like the start of this year, 2025, we're going to be starting 2026 with valuations as measured by the forward price to earnings ratio at fairly elevated levels at around 23, 24 times next year's earnings, or what we call forward earnings. And one of the reasons that returns have held in so well here over the last year, despite elevated valuations, is because earnings have really outperformed expectations, looking at double-digit earnings growth. And it looks like the market is expecting the same looking in 2026. And I mention all that to help set our own expectations as we head into 2026. One of the reasons that the market has outperformed expectations in 2025 is because corporate earnings have grown well beyond expectations. They continue to beat expectations in spite of some of the headwinds that we've seen around inflation, around tariff concerns. Corporate earnings have been very, very strong, and they're expected to continue to be strong in 2026. In fact, the current expectations are for year-over-year earnings growth in 2026 to be about 14%. If that comes to fruition, that will certainly help to justify that next leg higher in equity returns. But if it falls short of expectations, if we start to see analysts and companies start to ratchet back expectations for future earnings growth, that could cause a little bit of a sell-off or concern among equity investors. So something to keep an eye on. One of the things that's top of mind for me is the fact that Jerome Powell's term as Fed chair will be coming to an end in May. And so we are waiting for an announcement from the Trump administration to hear about who will be nominated to replace him. Currently, the odds are pointing to either Kevin Hassett or Kevin Warsh, 2 well-known economists, because ultimately that has an impact on expectations for monetary policy in the future of short-term interest rates, which then impacts inflation expectations. So a lot of this is related. At the same time, just taking a step back and looking at the broad economy, we know that inflation is still a concern, but perhaps more so, there are concerns around the jobs market. We've seen the job market soften in recent months. The unemployment rate has risen to 4.6%. So still not too high, but it's drifting in the wrong direction. And so there will continue to be questions about the softening labor market and what impact that could have on the outlook for the consumer. For now, we do expect the economy to continue growing in 2026. We believe that the odds of a recession are very, very low. And part of that is supported by not just the fact that we've seen a few rate cuts by the Federal Reserve, but we're also going to see some meaningful fiscal stimulus in 2026 that comes to us through the OBBB, which is the One Big Beautiful Bill Act, which will go into effect next year. So there are some positive headwinds here. Right now, we're all waiting for a ruling from the Supreme Court on the Trump administration's use of IEEPA. These are the emergency powers that he exercised to put these tariffs in place several months ago. And so the question is, will they look to roll these back? In which case we might see tariff uncertainty come back into the picture, at least for a little bit. We expect a ruling in late January, perhaps early February. And at that time, if these are scaled back and if the Supreme Court does rule against him, then these tariffs would likely be replaced by other tariffs. Let's remember that President Trump and presidents in general, they do have unilateral authority when it comes to trade policy. They have a lot of discretion there. And so he would likely look to replace these tariffs fairly quickly. Next year, just like this year, it's going to be really important to stick to your long-term discipline. Try not to deviate if you do encounter volatility. Stick to that long-term plan, and we'll certainly be there to help you along the way if that does happen. I'll leave it there for right now. I'll look forward to seeing you again in 2026. Happy New Year.